Welcome back, everyone, to Money and Markets. We've heard about the trends in the markets and the economy that will likely shape the last 4 months of 2010. But how do money managers see the rest of this year playing out, and how are they positioning their clients' portfolios? Joining us on set to answer those questions are Sebastian Lieburn, the Chief Investment Officer of Weiss Capital Management, and Anthony Pulieri, the Managing Partner and Chief Investment Advisor at United Bullion Group. Sebastian, I want to start with you here. What is your general investment strategy heading into the fourth quarter?
Yeah, that's a good question, Jamie. We're actually pretty conservatively positioned at this point, focused more on fixed income generation from not only fixed income investments, but some select high-quality dividend-paying companies and ETFs. Our biggest concern here is that the economy slows in the second half of the year, much greater than a lot of market participants currently expect. If that's the case, then stock markets in particular have a long way to go down, even from here. So we were actually quite conservatively positioned. In fact, we actually became a lot more conservative starting in April and May when we saw economic indicators start to deteriorate quite a bit.
Anthony, you agree, and what's your strategy?
My strategy is park your money on the sidelines in cash and get it out of the risk assets, especially stock markets, equities, mutual funds, because there's just that uncertainty out there and that fear. And until that fear subsides and there's stability into the economic data coming out on a weekly basis, you want to keep your money where you know it's going to be there. And I believe, I'm a big believer in gold, and I've been buying gold for years. I'll continue to accumulate gold. I believe everyone needs to have some gold in their portfolio. I believe that ratio from the old 10 to 15% of your portfolio should be more towards 30 to 40% because of that fear factor. That's why you're continuing to see gold rise. So I do believe that parking on the side and waiting for this fear to subside, if it does in the short term, is the way to go.
Okay, Anthony, I know that you're an expert on commodities. Let's talk some other asset allocations. What is your take on commodities versus some of those other asset classes?
I think commodities, obviously, we have the massive money printing that's going on and the increase in the monetary base and the fear of inflation. What you're seeing, ties into the currencies, the commodities, where countries like Australia, Brazil, New Zealand, and Canada, there's a massive amount of resources. There's demand for the resources, the large exporter in soybeans, sugar, and so on. And what you're seeing is the big demand and the fear of inflation for the future because of all this massive money printing globally. And what you're seeing is a rise in the currencies and because of that demand for the commodities. So I believe food and commodities, wheat, we've seen wheat run wild for obviously Russia had a big part of that, but I do believe that the demand for food is never going to go down. There's still going to be demand for the metals sector. I think base metals in the short term will probably contract with the economy, and eventually there's some opportunity inside the base metal sector to make some money. So I do believe that commodities in the short term, unless something changes drastically, is where the smart money will continue to be.
Okay, Sebastian, you agree? Your thoughts?
I agree with that for the most part. We like gold as well. We think gold's we don't think it's obvious. Look at the charts in a secular bull market, whereas stocks are probably in a secular bear market. That doesn't mean you can't have ups and downs. See, we have different strategies at Weiss Capital Management, okay, that have different objectives. Some are focused squarely on fixed income. Some have equity exposure to them, but we have a lot of variability to bring it up or down. And right now we're at pretty much at our lowest level as far as equity allocation. Again, focused on dividend-paying stocks exclusively at this point. It's the only area in the market that we think, from this point out, gives you pretty decent returns 3 to 5 years out, for the most part. So we like gold as well. We see the markets struggling, particularly the equity markets struggling, maybe into October, and then rallying into the November elections in anticipation of maybe some clarity coming out. But not particularly optimistic. You have to become more of a trader in this market as opposed to buy and hold.
I don't want you to give too much away here, but give me some of your specific plays that you'd make, stock sectors, wherever it may be.
I think if you'll see that since the April highs in the equity market, the 4 sectors that are outperforming are, by their very nature, very defensive. Telecom, healthcare, everything else is more cyclical is on the bottom. I think that's telling you something. The financial volatility that's picked up since April is also telling you that the markets are very concerned and they're very uncertain. So as Anthony said, we agree. We have a lot of cash right now on the sidelines, but cash isn't paying you anything. So what do? Our clients don't want to just sit in cash and earn nothing. So we have to focus on safe income, and there is some of that. Corporate bonds are still attractively priced, more or less, relative to stocks and the fact that you don't get the equity market volatility. But individual names, again, when it comes to equities, we like some of the large cap names, as I said. Johnson & Johnson's okay here, Exxon 3-4%, 5% yields on some of these companies, whereas the corporate bonds are giving you 2%. IBM just priced a 3-year bond at 1%. I mean, that's just not going to get it done. So high cash, select dividend-paying companies, and again, you have to develop a trader-type mentality as well.
I think you hit the nail on the head when it comes to that buy and hold strategy that everyone's so comfortable for the last 3-4 decades is gone. And to accumulate money on a monthly basis, it's not going to happen like that because of the volatility out there inside the economy. So I do believe that you know, you got to be a short-term trader. Yeah. You have to pick off profits. You have a profit instead of being greedy in 20-25%. You see 8 to 10, take it off and don't be greedy. Dividend-paying thing, you know, the Verizons of the world and paying out 7% dividends is a great play. I do believe that stocks are definitely in a cyclical bear. It's been a 10-year bear. It's down about 25% from the peak, and I do believe that it'll continue to go down. I think fall is going to be uglier. Wait till you see the volume come back into the market. I think you will see once volume comes back in, I do believe you'll see stocks tumble down, and you will continue to see gold run higher.
Do you have a price target either for the stock market or for other assets you're going to see for the end of the year?
I think that we'll see the Dow test 8,400, I believe. If it breaks through 9,000, I think it'll hit 8,400 in lightning speed. And I do believe that we'll see gold break through 1,500 with ease within the next 4 to 6 months. I'm expecting to see us breach 1,300 an ounce. The Indian wedding season's just started this week. There's huge demand for that. Demand has been pretty good in the beginning. We'll find out this weekend after this weekend passes by. Obviously, central banks now are net buyers of gold. They're no longer net sellers of gold, which is a huge fundamental trade change from the past. So I do believe we'll break 1,300 possibly this September, because we're at 1,240 right now. So we're right there on the cusp. And, you know, you have these home sales numbers down about 27.5%, then 12 on existence. It's there's that fear trade that I think is going to run gold up, and I do think the Dow will test 8,400.
Very possible, very likely, in fact. We're humble enough not to actually put out explicit stock market targets for the end of the year. I don't think that's that useful. We prefer to look at the data on a daily basis, the incoming economic data and financial market indicators, and reassess our strategies accordingly. But you know, I would agree with that the trend right now is actually not good at all. In fact, in August, which is, as you mentioned, Anthony mentioned, it's been a very light volume as traders are on vacation for the most part. Come back next week, we get a bad unemployment number, and it could get pretty ugly. That having been said, it's very much a tradable market. You got to keep in mind that we have a fiduciary responsibility for our clients' assets, so we have to put it to work wherever we think the returns are best with the risk that we're taking. And that means that we oftentimes, as you said, if you have a profit or something, if it's 8 or 10%, it's better to take it as opposed to get greedy. This is not the market to be greedy on.
Okay, Sebastian, I want to ask you, banner headline, fourth quarter, what would you tell investors?
Money on the sidelines, keep it. That having been said, you could have a rally here. As I said, we could see the market going down maybe into October, forming some kind of low, and then rebounding perhaps significantly in the latter part of the fourth quarter. So if you have some powder dry, so to speak, you can put that money to work. And you? Banner headline that I would read in the newspaper come December.
GDP goes negative, gold breaks 1,500, and fears back similar to back to 2008.
I want to comment on that. That's a great point, because right now strategists have GDP for the second half of the year at 2.5%. We think that's way too high, and it's going to be coming down significantly in the next couple of weeks to several months. All right, gentlemen, thank you both for being here. We appreciate your time.
You bet, Jim.